If I had to look at one company going into earnings today from scratch, knowing what I know about how this market rewards growth, how quickly sentiment can turn, and what Wall Street still seems to be missing about SoFi, I would look at this story very differently. Most people think earnings are about one headline number, maybe revenue, maybe earnings per share, maybe whether the stock pops in the first 5 minutes. But that is not what this setup is really about anymore. This one is about quality of growth, product mix, and whether the business underneath the ticker is getting stronger faster than the market is willing to price in. It is Sunday, April 19th in New York, so go ahead and tell me in the comments what day and date you're watching from. And if you value the work I put into these breakdowns, support the channel by subscribing and commenting John AG Best. That helps more than you think. Now, come April 29th, we are going to see some numbers. And I think a lot of people are walking into that report looking at SoFi the lazy way. They're staring at the obvious stuff. They're staring at the stock chart. They're staring at whatever the loudest account on the internet said this week. They're staring at whether the technology platform had a messy comparison again. And yes, that part matters. I'm not pretending it doesn't. But I think the bigger story is hiding in plain sight, and it has a lot more to do with the shape of the business than with one noisy segment. Because when I step back and look at this thing, I don't see a company that needs everything to be perfect. I see a company that needs enough of the machine to keep spinning. And right now, that machine looks a lot more mature than people are giving it credit for. Based on recently published company numbers, SoFi exited last year with roughly $1 billion in quarterly adjusted revenue, a little over $300 million in adjusted EBITDA, and about $170 million in net income. It also finished that quarter with record member growth and record product growth, pushing the platform to just under 14 million members and a little above 20 million products. That matters because it tells you the business did not limp into this year. It came in with momentum. And then management laid out a first quarter guide that, on its own, is already strong. We are talking about roughly $1 billion and a little more in adjusted revenue, around $300 million in adjusted EBITDA, about $160 million in net income, and earnings per share around the low teens. So before anybody starts doing victory laps about a beat, understand this. The official bar itself is not low. The company already told you to expect a serious quarter. There's another angle here people gloss over, and that is deposits. A digital financial business gets more powerful when it is not just originating loans and celebrating app downloads, but actually becoming a place where members park real money. By the end of last year, total deposits had climbed to nearly $38 billion, which gives the company a funding base that looks a lot more serious than the version people still carry around in their heads. That lowers dependence on more expensive funding and gives management more flexibility when it decides where to push and where to stay disciplined. And don't overlook the fact that brand awareness kept rising while that happened. Recently published company materials showed unaided brand awareness hitting a record level. At the same time, the company was stacking new members and products. That matters because when the brand starts doing more of the work, growth can become less expensive. In other words, the company is not just getting bigger. It may be getting more efficient at getting bigger, which is exactly the kind of detail that does not always show up in the fastest take after earnings. So where do I think Wall Street is missing it? I think it's missing the composition. Not just how much SoFi is growing, but where that growth is coming from. See, member growth by itself is nice. Product growth by itself is nice. But when the same customer keeps stacking more products inside the same ecosystem, the economics start to change. Acquisition costs get spread wider. Cross-buy improves. The relationship gets stickier. And suddenly the business doesn't need to fight for every dollar the hard way. From recent company updates, cross-buy had already pushed up to around 40% by the end of last year. That is not a flashy metric, but it is exactly the kind of metric that changes what the next few years can look like. That's why I'm less interested in whether one line item looks dramatic, and more interested in whether the member engine and the product engine stayed healthy in the quarter. If those two kept moving, then a lot of the rest starts to take care of itself. And I know what some people are going to say. They're going to say, yeah, but the technology platform is still the weak spot. Correct. It is. The company itself has already shown that the total account count on that side took a big hit after that client loss, and those comparisons do not magically disappear overnight. But here's the thing. A weak technology comparison and a weak company are not the same thing. Those are two very different claims. And I think people keep blurring them together because it makes the story simpler than it really is. Even after that hit, the platform still serves well over 120 million accounts globally. That is not a dead business. That is a business working through an ugly reset. Now let's talk lending because whether you love SoFi or hate it, this is still the muscle car under the hood. Personal loans are likely still doing the heavy lifting. That should not surprise anybody. They've been the workhorse for a while. But what matters more to me now is that the company keeps finding ways to make that lending engine less balance sheet hungry and more fee friendly. The loan platform push is a big part of that. Last year, the business expanded that channel again, and it even announced a multi-billion-dollar agreement tied to personal loans through one of its platform relationships. That kind of move matters because it gives SoFi another way to participate in demand without having to do everything the old-fashioned way. That can support revenue quality, even when the macro picture gets a little choppy. And then there is housing, which I think a lot of people are underestimating. Not because housing suddenly became easy, it didn't, but because the backdrop is less hostile than it was a year ago. The average 30-year mortgage rate this week was a little above 6%, down from the high sixes a year earlier. That does not mean home lending explodes overnight. I'm not saying that. What I am saying is that when rates stop feeling like a brick to the face, activity can start thawing. For a company trying to build out home loans from a smaller base, that thaw matters. It doesn't have to dominate the quarter to matter. It just has to keep moving in the right direction. Student lending is another one where the backdrop could quietly help. Why? Because households are still under pressure. Recent household debt data showed total balances rising again, and recent credit reports showed student loan delinquency trends weighing on consumer credit scores after repayment frictions returned. That is exactly the kind of environment where people start looking harder at refinancing, monthly payment relief, and better loan terms. No, that does not guarantee a blockbuster student loan quarter, but it does create a more believable tailwind than people had a year or two ago when this part of the business was easier to ignore. Now swing over to financial services because this is where I think the story gets even more interesting. This segment has quietly become the part of the business that changes the whole conversation around SoFi. Money products, Relay, credit cards, Invest, all of that does more than pad a slide deck. It deepens the relationship, it increases engagement, it creates more reasons for members to stay in the app instead of wandering off to 3 other platforms. And when you pair that with new product pushes, the effect compounds. The card push is one example. Late last year, the company introduced a new card product built around rewards, savings features, and credit building. That doesn't mean the card business suddenly becomes the whole company. It does mean management is still widening the funnel and giving members one more place to park behavior. And that matters, because every extra behavior inside the ecosystem can support monetization later. Invest probably had a tougher quarter than the bulls want to admit. Let's be honest about that. Markets have been jumpy. People get cautious when headlines get messy. So I would not build the whole thesis on a monster surge in investing accounts right here. But I also wouldn't make the opposite mistake and assume weaker enthusiasm in one quarter cancels the broader cross-sell story. That would be too neat, too simple, usually wrong. And then we get to crypto. This is where people either get wildly excited or wildly dismissive, and I think both sides can overdo it. The company's crypto launch is real. It is not some vague someday project anymore. The rollout started late last year, and management has been clear that it sees digital assets and blockchain rails as part of the broader product stack. That matters because crypto, when it works inside a regulated ecosystem with existing members, can be a high-margin activity and a very effective engagement tool. It can also change how investors think about SoFi's financial services mix over time. But here's my counterpoint. I do not think crypto alone is the magic trick. I think some people hear new crypto product and immediately project a straight line to infinite margin expansion. That is not how real businesses work. Launches cool off. Early adopters rush in first. Then normal demand shows up, and normal demand is usually less dramatic. So yes, crypto can help. Yes, it can lift mix. Yes, it can surprise on engagement. But if you build the entire bull case on that one thing, you are probably oversimplifying the quarter. The better argument, in my opinion, is that crypto is one more piece in a business that is already becoming more diversified, more fee-driven, and less dependent on any single lane than it used to be. And that brings us back to margins. This is the part that can really change the tone after earnings. At the end of last year, fee-based revenue had already climbed to the mid-40s as a share of adjusted revenue. Financial services and the technology platform together had become a much bigger piece of the company than they used to be, and the loan platform business kept pushing the model toward more capital-light revenue. That is important because a company does not need to grow the fastest in every segment if the mix keeps getting better. Sometimes the cleaner story is not faster growth, sometimes it is stronger growth. That difference is where people get caught sleeping. So when I look at this quarter, I do not just ask whether revenue beats by a little. I ask whether the margin structure keeps proving out. I ask whether the product machine stayed healthy. I ask whether the member engine kept feeding the rest of the ecosystem. And if those answers are mostly yes, then the market may have to start treating SoFi less like a one-trick lender and more like a scaled financial platform that is gradually earning a different multiple. Now, could the stock still sell off even on a good report? Absolutely. That happens all the time. A stock can beat and still get punished if expectations ran too hot into the print, or if one weak metric steals the spotlight, or if guidance lands only fine when traders wanted fireworks. I'm not going to sit here and pretend every strong quarter gets rewarded instantly. That would be nonsense. Sometimes a very good report meets a stock that already wanted to rest. But that short-term reaction is not the same question as whether Wall Street understands what is improving. And I'm not convinced it does, because if the quarter comes in around or above guide, if earnings land somewhere in that low teens range or better, if the product additions are still strong, if financial services keeps carrying more of the weight, and if management sounds confident about the full year, then the conversation around this company could shift again very quickly. Remember, the full year outlook already called for roughly 30% revenue growth, a big jump in EBITDA, and earnings power that keeps climbing. That is not the profile of a business limping along. And one more thing, if you're successful, share your success story in the comments so others can stay motivated. Because what I think Wall Street is missing here is not that SoFi has no risks. It has risks. It absolutely does. Technology comparisons are messy. Credit can always turn. Markets can get weird. A hot stock can punish late bulls. All true. What I think it is missing is that this company may be crossing from fast growth story into something more durable than the old debate allows. A business with a broader funnel, better mix, more fee revenue, more products per member, more ways to win than it had before. That does not mean every quarter will be clean. It means the machine may be better than the narrative. So as we head toward April 29th, I'm not watching this like a coin flip. I'm watching it like a test of whether the market is finally ready to admit that the SoFi story is no longer just about one loan category, one macro swing, or one legacy talking point. It may be about a platform that kept building while a lot of people were still arguing with last year's map. And if that's what the numbers show, then a lot of people are going to realize they were looking in the wrong place the whole time. As always, this is here to help you think, not to tell you what to buy or sell. Do your own homework, weigh your own risk, and treat everything I say as education, not personal financial advice.